Welcome to SS2 Economics, Term 2, Week 2. Today we study inflation, one of the most important and most discussed economic phenomena. Inflation is a sustained rise in the general price level of goods and services in an economy over time. It is measured by the Consumer Price Index, CPI, which tracks the average price of a basket of goods and services typically consumed by households. When inflation is high, the purchasing power of money falls, each naira buys fewer goods. Nigerians have experienced severe inflation throughout the 2020s, with the CPI rate reaching over 30% by 2024, driven by fuel subsidy removal, exchange rate depreciation, supply disruptions, and excess money supply. Understanding inflation, its types, causes, and remedies, is essential knowledge for every Nigerian citizen and a key topic in WAEC economics. Inflation is measured by the rate of change of the Consumer Price Index, CPI. The CPI is constructed by the National Bureau of Statistics, NBS, by selecting a representative basket of goods and services, assigning weights based on the share of each item in typical household spending, collecting prices of these items regularly, monthly, and calculating the percentage change over a specified period, month-on-month or year-on-year. Nigeria uses December of a base year as the reference period. The food subindex is particularly important in Nigeria, where food accounts for over 50% of household spending. Effects of inflation on income distribution. Inflation hurts people with fixed incomes, pensioners, workers with fixed salaries, who find their real purchasing power declining. It benefits debtors, who repay loans in cheaper naira, and harms creditors, who receive cheaper naira back. On savings, high inflation erodes the real value of savings held in low-interest bank accounts. On business planning, unpredictable inflation creates uncertainty, discouraging long-term investment. On exports, inflation makes Nigerian goods more expensive in foreign markets, reducing export competitiveness, unless offset by naira depreciation. On the exchange rate, high inflation relative to trading partners puts downward pressure on the naira. Inflation is classified by its rate and by its cause. By rate, creeping inflation, below 3% per year, is considered normal and even beneficial, as it encourages spending. Spending now is better than waiting for prices to rise. Walking inflation, 3 to 10%, is moderate and manageable. Running or galloping inflation, 10 to 100%, is seriously harmful. Hyperinflation, above 100%, is catastrophic. It destroys the economy and trust in the currency. The Zimbabwe hyperinflation of 2008 saw annual inflation exceed 79.6 billion%. Nigeria reached over 30% in 2024 in the running/galloping category. By cause, demand pull inflation occurs when aggregate demand exceeds aggregate supply, too much money chasing too few goods. Cost push, supply side, inflation occurs when production costs rise, higher oil prices, fuel costs, wages, or import prices, shifting the supply curve left and pushing prices up. Structural inflation is caused by structural weaknesses, supply bottlenecks, poor infrastructure, inefficient markets, common in developing countries. Imported inflation arises from rising prices of imported goods, especially petrol and raw materials, which Nigeria imports heavily. Built-in, wage price spiral, inflation occurs when workers demand higher wages in response to rising prices, which raises production costs, which further raises prices, creating a spiral. Nigeria's high inflation in the 2020s has multiple causes. First, fuel subsidy removal. June 2023, the removal of the costly petrol subsidy caused fuel prices to multiply overnight, raising transport costs and the prices of all transported goods. Second, exchange rate depreciation. The naira lost over 70% of its value against the US dollar in 2023, making all imported goods, especially petrol, manufactured goods, and food, much more expensive in naira terms. Third, monetary expansion. The CBN's financing of the government's fiscal deficit, through ways and means advances, expanded the money supply significantly. Fourth, supply-side constraints. Nigeria's inadequate road infrastructure, irregular electricity, and food production disruptions, from insecurity in food-producing states like Benue, Kaduna, and Anambra, reduce the supply of food and goods, pushing prices up. Fifth, insecurity. Armed groups in the Middle Belt and Northwest have displaced farmers and disrupted agricultural production. Sixth, global commodity prices. The Russia-Ukraine war of 2022 raised global food, wheat, cooking oil, and energy prices, affecting Nigeria through import prices. Inflation can be controlled through monetary, fiscal, and supply-side policies. Monetary policy measures. The CBN raises the monetary policy rate, MPR, making borrowing more expensive and reducing aggregate demand. Increasing the cash reserve ratio reduces bank lending and money supply. Open market operations, selling government securities, withdraws naira from circulation. These are the CBN's primary anti-inflation tools and were deployed aggressively in 2023 and 2024. Fiscal policy measures. Reducing government spending reduces aggregate demand. Increasing taxes withdraws money from households. Reducing the budget deficit cuts the need for deficit financing and money creation. Supply-side policies. Improving infrastructure, especially electricity and roads, reduces production costs. Increasing agricultural productivity through extension services, irrigation, and fertilizer subsidies increases food supply. Reducing import duties on essential goods temporarily lowers imported prices. Income and price controls. Price controls, setting maximum prices, can reduce inflation in the short term but cause shortages in the long run. Wage controls limit the wage price spiral. Nigeria has experimented with price controls, but they tend to create black markets and reduce supply. Exchange rate policy. Stabilizing the naira reduces imported inflation. The 2023 naira depreciation worsened inflation in the short term, but a stable exchange rate going forward should reduce imported inflation pressure. To summarize, inflation is a sustained rise in the general price level. It is measured by the Consumer Price Index, CPI. Affects, hurts fixed income earners, savers, and creditors, benefits debtors, discourages investment, reduces export competitiveness. Types by rate: creeping, under 3%, walking, 3 to 10%, running, 10 to 100%, hyperinflation, above 100%. Types by cause: demand pull, excess demand, cost push, rising cost, structural, supply bottlenecks, imported, rising import prices, built-in, wage price spiral. Nigeria's inflation drivers in 2024: fuel subsidy removal, naira depreciation, monetary expansion, supply-side constraints, insecurity, global commodity prices. Controls: monetary policy, raise MPR, CR, fiscal policy, reduce spending and deficit, supply-side policies, infrastructure, agriculture, income and price controls, short-term, exchange rate stabilization. For WAEC, define inflation and CPI, distinguish demand pull and cost push, list causes and effects of inflation, explain monetary and fiscal measures to control inflation.